Have you ever wondered about the best way to save for retirement? Today, we are diving into the world of retirement accounts.
And you're here to open a
SEP retirement account.
In this video, we will demystify the 6 key retirement accounts: IRA, Roth IRA, SEP IRA, 401k, 403b, and 457b. Understanding the various options can be a game changer for your financial future. I know it can be a bit overwhelming with all the acronyms flying around, but don't worry, by the end you will have a clear understanding of which one might be the best fit for you. So let's jump right in. There are 2 major categories when it comes to these retirement accounts. There's the employer-sponsored accounts and individual retirement accounts. The first category is the individual retirement account. In this category, you have the traditional IRA, Roth IRA, and SEP IRA. And because they are self-directed, there are a wide range of investment options you can choose from. Anyone with earned income can open and contribute to an IRA. IRS defines earned income as taxable compensation, such as wages, salaries, commissions, or net income from self-employment. However, earnings from rental income, child support, interest, and dividend income do not qualify. An IRA is one of the most common retirement savings accounts. When opening one, you will need to choose between 2 main types, either a traditional IRA, which is the reliable old friend of retirement accounts, or a Roth IRA, which is the younger and cooler sibling. The way they differ is when you get your tax breaks. Essentially, you have the choice of receiving a tax deduction upfront or tax-free withdrawals in retirement, but not both. Traditional IRA allows you to contribute pre-tax money and gives you an immediate tax break. You pay taxes on withdrawals later. For example, let's say your taxable income is $100,000 this year and you contribute $6,000 in a traditional IRA account. Your taxable income for this year is lowered by $6,000 to $94,000. This means instead of paying IRS now for the taxes on the $6,000, you have more money to invest and compound to make you even more money. When you take out money in retirement, both the initial investment and the gains become your taxable income in the year you withdraw it. With Roth IRA, you contribute after-tax dollars by paying taxes upfront. And when it's time to make withdrawal, all your earnings, including interest and capital gains, are completely tax-free. Contribution limit for 2024 is $7,000, and for those 50 and older, there is an additional $1,000 of catch-up contributions. The $7,000 is the total combined amount across all of your traditional and Roth IRA. You cannot contribute the maximum to each account separately. You have until tax day to make contribution for the prior year. That means in 2024, you can contribute toward 2023 tax year limit of $6,500 until April 15. And as of January 1st, 2024, you can also make contributions toward your 2024 tax year limit of $7,000 until tax day of 2025. Although there is no income limitation to contribute to traditional IRA, there is a strict income limitation for Roth IRA. To qualify for Roth IRA contribution, a single filer must have a modified adjusted gross income of less than $161,000 in 2024 and $240,000 for married couple filing jointly. High-income earners that don't qualify for Roth IRA can use the backdoor Roth conversion by contributing first to a traditional IRA and then convert it to a Roth IRA. The minimum distribution requirement also differ between the two. Traditional IRA has a mandatory minimum distribution at age 73 when you are required to withdraw annually from your account. Roth IRA does not require withdrawals until after the death of the owner. Both traditional and Roth IRA have penalty-free withdrawals at age 59.5. However, for Roth IRA to be tax-free and penalty-free, you have to also meet the 5-year rule, which requires a 5-year holding period before any withdrawal. If you need access to the money before the age of 59.5, there may be early withdrawal penalties. With a traditional IRA, you would have to pay both income taxes and a 10% federal penalty tax on any amounts you take out. There are some exceptions where you may be able to avoid penalty, but not taxes, such as first-time home purchase. There's more flexibility with Roth IRA. There's no withdrawal penalty unless you withdraw more than what you have contributed in total. So, which one is better? It all depends on your personal circumstances. The most crucial factor is your tax bracket in retirement years. If you expect to be in the same or lower tax bracket in retirement, then traditional IRA makes the most sense. But if you expect to be in a higher tax bracket in retirement, then Roth IRA is definitely the way to go. Let me explain. Imagine scenario number 1. You have a stable job and earns a comfortable income that allows you to save for retirement. Your dream is to retire in your 60s, doing yoga every day and soaking up the sun on beautiful beaches, while living off of your retirement savings. Then traditional IRA is going to give you the most amount of money in the long run. It's likely that you are now in a higher tax bracket, so you can deduct your contributions from your taxable income and reduce your current tax liability. Because you don't pay taxes on any capital gains, dividends, or interest earned in the traditional IRA until withdrawal, the tax-deferred growth can lead to more substantial growth over time. When it's time to use that money during retirement years, your kids may be out of the house, your mortgage may be paid off, so you need less income. And with this lowered income, you can take advantage of the lower tax rate. Now imagine scenario number 2. You worked as an executive and you've been climbing the corporate ladder your whole career. You love your job and find immense satisfaction in leading innovative projects. You envision yourself continue to work well into your 60s because you believe that by staying active at your job, it is fulfilling and it provides a sense of purpose. You also have been diligently putting money away and building a robust retirement savings. If you fall in this category, it's likely that your tax bracket will be drastically higher in those retirement years. So mathematically speaking, Roth IRA is the most effective because you avoid paying taxes on any capital gains, dividends, or interest earned in your Roth IRA account. You see, it's not a one-size-fits-all approach. It's more like which size fits me. Your choice today will echo into your retirement years. However, a popular consensus is that Roth IRA is more effective than the traditional IRA, especially for investors starting young. Because for the young investors that continue to put money away for savings, the gains on your Roth IRA will one day equal the annual contribution thanks to the power of compounding. If used properly, Roth IRA can be a very powerful tax-saving tool. Take, for example, Peter Thiel, the co-founder of PayPal. He grew his $1,700 Roth IRA account from 1999 to a $5 billion fortune 22 years later. Peter Thiel is 56 years old today, so in less than 4 years, when he turns 59 and a half, he can withdraw $5 billion from his Roth IRA account, all tax-free. He doesn't need to pay a penny of taxes on the $5 billion because he already paid taxes on the initial $1,700 back in 1999.
What?
Let's be clear, it's highly unlikely for an average person to wake up with a $1 billion Roth IRA account by investing in traditional assets. But it's certainly possible to reach the $1 million mark if you start early, contribute consistently, and invest in high-quality assets. Watch my video here for Roth IRA investment strategies to become a tax-free millionaire. Now let's discuss the Simplified Employee Pension IRA, or SEP IRA. This is the setup for self-employed individuals and small business owners. It allows for higher contribution limits compared to a traditional or a Roth IRA, making it an attractive option for those with variable income. If you're finding value in this video, please give it a thumbs up. It really makes a huge difference. Now onto the other categories: 401k, 403b, and 457b. Don't be overwhelmed by all these numbers. They are simply sections in the IRS tax code. You can find more detailed information of these plans on the IRS website. Unlike the previous category of IRAs, these accounts are tied to employers and you are limited to whatever your company is offering you at the time. 401k is the most typical retirement accounts offered by employers in the private sector. Most 401k plans are tax deferred. This means you don't pay any taxes on the money you contribute or any gains, interest, or dividend until you withdraw from the account. The beauty of a 401k is that most employers even match a certain percentage of your contributions. You should definitely take advantage of it because it's essentially free money. In 2024, you can contribute up to $23,000 a year. And if you're 50 or older, you can make catch-up contributions of an additional $7,500. The catch-up contribution can be a powerful tool for those looking to boost their retirement savings in the final years of their career. The IRS allows penalty-free withdrawals from 401k starting at age 59.5 and requires withdrawal when you reach the age of 73. 403b is similar to the 401k, but it's typically offered by nonprofit organizations, schools, and certain government agencies. It operates on the same principle, allowing pre-tax contribution and tax-deferred growth, but there might be slight differences in investment options and regulations. 457b is primarily available to state and local government employees. The key difference is that it allows for additional catch-up contributions if you're within 3 years before your eligible retirement age. Make sure to consult with your plan administrator if you are interested in putting more money in your 457b. There you have it, the 6 key retirement accounts. Everyone's situation is different, so consult a professional to see what options and allocation is best for you. I'm not an accountant or a financial advisor, so this information is not intended to be personal financial advice. Thank you for watching, and I will see you in the next video.